everyone. Thank you for joining in. Begin right now. So it has been an interesting year for fixed income. I think we're at the right point in the market cycle to be evaluating this as an asset class. And at the same time, the landscape has been changing very swiftly. So we thought it would be a good time to look at what the changing landscape of fixed income investing looks like and how there is still an opportunity for investors to look at this as an asset class. I'll be handing over to my colleague Niranjan, who's the head of strategy at ithought.
Thank you, Samrita. Say a lot has happened with this new passing of the new finance bill. Fixed income is completely, how you approach the fixed income, the approach to fixed income has radically changed. So previously, most people used fixed income for what purpose? I used it for tax efficiency. But today, with what's happened in the finance bill of 2023, where there were some surprise amendments that came in, during the first bill that was filed, that was built, that was put through during the announcement of the budget, there they had decided to tax for the MLDs. MLDs was something that a lot of investors, I would say a lot of the high net investors were on that side because MLDs gave them a tax arbitrage. So that tax arbitrage was closed. And then during the course, the last 2 weeks of March, the amendment to the bills came, and there we also got to know that the debt taxation going forward also changes. So indexation is no longer relevant from any investments made in the investments will no longer be relevant. Investments made into debt post April 1st from today onwards will not carry any more indexation benefits. So, and apart from this, the other bits that happened on the bond market space were a lot of small things. It's a series of small steps that have happened over the course of all these years. And one very interesting reform that happened was the bond market reform. So previously we had a lot of the bonds that were very highly priced at face value has now been brought to a 1 lakh face value. So it's a very interesting that the RBI has done. So bringing even the private bonds to a cheaper price. And in fact, RBI bonds today are available at a face value of 10,000. So that's very interesting, the thing that has happened. And the other point is on the inflation side and the interest rates. So you know how interest rates and inflation and interest rates go hand in hand. What had happened in that case, in this case, was we've had, we being an emerging economy, okay, so we're used to these kind of rates. So our inflation has always been fluctuating between say 4%, 4.5%, 5%, 4.5%, and somewhere near 8ish. It's been the band. I mean, there will be some outlier years here and there where we go beyond the band, but we've largely stuck, which I would classify as most emerging economies have largely stuck to this band. And in 2013 is when we had the Urjit Patel committee reforms that came in with the erstwhile the then governor. So he had brought in the CPI targeting mechanism that had come in, and that was implemented. So which basically means now RBI is now more accountable in terms of adjusting interest rates purely with respect to the CPI, and not so that's been something that's quite interesting that's happened. So the ramifications of which we are seeing today, I mean, I would say it's a very positive ramification in terms of interest rates. Today, I think from today, we see that interest rates might not really go much more from here, which basically means we might be here for a little while. And I think would probably also be the reason why you should be looking at fixed income at this point in time. Because fixed income, unfortunately, from what we've seen over the years and over a lot of these years that we've seen, and fixed income is that people tend to invest with a tail. People tend to invest after the bottom has been reached, because that's the unfortunate bit about it. Then the other point also that I think should be brought in here is we are in a situation where we have low global growth. The West you're not getting the news from the West is not that encouraging, and as a result, it's a bit of a worry. And also to compound to their problems, today they are stuck with a problem of high interest rates. and inflation, very high inflation. In fact, I think yesterday's your EC European your EU numbers have come at 6.9%. I mean, it's still high for somebody for some. It's still high for someone who has been at, I would say, 0.5% or 1% inflation. That being also said, the US is no better. I mean, in that case, so which means basically the entire West is in a rut. So given that fact, and these people and given the fact that all these countries, the entire economies have run at near zero interest rates for the last 10, 12 years, that has come to a naught. So, which simply means that they have to, I mean, their situation has changed. So, with them not growing the way they should be growing, and they also having higher interest rates, it's going to be, it's a very, very, very complex landscape. It's not as simple as that. And the other thing is that with the elections coming up next year, which means the government, from where we see it, or for that matter, any government, will not try to tinker too much with administrative reforms. So whatever reforms is that we have here would be the last of the bits until the election is over. And that being said, this year's fiscal deficit numbers are, I think, will be in line. We are in for I would say, a well-managed fiscal deficit this year, simply because I think a large portion of it comes from oil, and with oil correcting here, and I think yesterday's third quarter numbers that came in, it is manageable. So even the CAD also is quite manageable from where we see it. And the last point that I want to bring here is on the volatility of the equity markets. The equity market volatility is been a product of just a moment. The volatility of the equity markets, because you had interest rates being hiked up everywhere around the globe, more so in the West than in the EMs. We don't think this volatility is going to subside anytime soon. And which you might have also been watching. So as a result, you're going to see a lot of volatility across asset classes. So that brings the interesting case, that brings the case of fixed income. Yes, sir. So people actually, okay, what do people usually think of fixed income? They think fixed income is easy. Well, I don't think so. Just that we had a myriad of issues that have come up over the last 10 years. I mean, it can start with you had demo first, and you had your PMC bond. We had the demo that came in, which basically changed the way how we address cash. When we had, I mean, I'm not getting to the nitty-gritties of it because I get wrong. I'm not even getting there. And then you had your fee categorization of mutual funds that happened in 2018, which basically said funds need to be bucketed properly because you have many names and a lot of funds, but very confusing for a lot of investors. Which led, and after which we had the ILFS default. We had the DHFL default. Incidentally, both were AAA. And then in 2020, in early 2020, we had the S banks 81 bonds written off. These were all for investors who thought fixed income is simply you just go lock in money in fixed income or something that yields interest. They thought it was safe. Clearly, it was not safe by any stretch of imagination. And then we also had LVB bonds, 82 bonds written off. And Franklin was a victim of this. Franklin was a victim of a lot of things. So they had to wind down nearly 6 schemes. So basically today they don't even have a debt. They don't have any presence on the debt side except for the short term. And not only that, we also had so see what had happened as a result of all this was, I mean, people's assumption that debt was simple and that it was safe. It does not mean just because you guaranteed a coupon does not mean that it is safe. So, and even the guarantee of the coupon was there. Even the guarantee of the coupon was thrown to the winds when you had your defaults of your bank, when you had defaults of private bank bonds. And the other two things that happened this year, very interesting things. First was the MLD tax arbitrage. So the last 2 years from where we were seeing as an institution was a lot of activity on the MLD space. So basically, the MLD space was using a loophole in the tax system. So which they tried to manipulate, and I think it was we as a house were not very comfortable. So and as a result, we never looked at that side. It was an arbitrage at the end of the day, and which the government I think figured out that they cut. And the other one, the last thing that happened this year was the indexation, the reversal of the indexation benefits. So what happens, which means basically you don't try to save taxes through fixed income investing. So after all this, you still ask, should I be in fixed income? The case of fixed income is very simple. You have higher interest rates where you are today. And also the other asset class, which is equity, is very volatile. Whether you like it or not, it's extremely volatile. And the other advantage that you have for fixed income is that the investment timelines are very flexible. I mean, you can lay your portfolio over a period of time with a lot of fixed income, with a different strategy of fixed income assets to make sure that you're invested into the asset. And the fourth point would be is when you want regular cash flows. So this is the tax rate from as how it stands from this year onwards, from this day, the 1st of April 2023 is how it's going to be. So equity still remains to be at your short-term, when your equity. So for debt, what is happening now is that your marginal tax rate applies. So which basically means you are going to be taxed as per your tax slab. So the long-term ramifications of the asset now just goes for a toss. So when you have equity exposure of close to about 0 to 35%, so which means what we would see is that there will be a lot of new NFOs that will be coming up from where we see it that have 0 to 35%. I mean over the 30 because this bracket that we see is now applicable largely for the. Just a moment, one moment. Yeah. So this is with respect to how the taxation now applies for fixed income, and this is where it stands. So the entire thing goes for a toss. Yes, I can go to the next thing. So which means basically what gives you LTCG here will be your balanced hybrid funds. So there are not too many funds that are available. So today at where we saw that from what we have seen, there are hardly about 5-6 funds that are the entire space, and they typically have very high expenses. They have quite a significant amount of equity exposure, and a lot of them have been locked in. And they have a lock-in of about nearly 5 years from where we saw. So which means what you could see now will be a plethora of issues, fresh issues that will try to chase this money, because now that they will use this as the tax arbitrage point for all the hot. This will become the new tax arbitrage mantra that will be pushed across, which in our view, I think we are not very big fans of. So which brings me back to the moot point. Are debt mutual funds still good? Well, inevitably, taxes is something that you cannot avoid. I mean, the taxes are something that whether we cannot avoid them. So which means all you can do is not, instead of avoiding them, you can defer them. And debt mutual funds still, thanks to the portfolio construct in a lot of cases, they still offer higher returns if you are to be looking at it in conjunction with a fixed deposit. And the other advantage that you will have here is that it offers portfolio diversification because you're not stuck to one issue. It's a very diverse portfolio. And most debt funds don't have any exit. They have hardly any exit load. And unlike a fixed deposit, they don't have any penalties. So which means it's quite good. And the other thing was also you can invest across the spectrum. You don't need to lock in everything at one point. So you can stagger your investment. Yes, I'm explaining. So how does your deferring of the tax help? So, I mean, I don't need to say much on this. So if you were to look, on the taxation side, so you can see what is happening for your tax compounding rate for the mutual funds vis-a-vis your fixed deposits by itself. This is the amount that you are able to, this is where you save. So which basically means it also helps what the primary advantage that you get from doing deferring your taxes, you let your money compound. So that's the biggest advantage that you have at where we are today. And yes, sir, next slide. So from here, my colleague Samyukta will be taking over.
Thank you, Niranjan. So just going back to what we saw in the last slide, right? If you look at how deferring tax actually helps, I think today you have two options. I think once your indexation benefit has been removed on your debt mutual funds, a lot of investors seem to be thinking that the return from an FD is going to give me the same amount at the end of my investment horizon. Now, the key difference is that when you have a fixed deposit, you're going to be paying interest on each year's, you're going to be paying tax on each year's interest, right? So if you're in the 0% bracket, then I think it really makes no difference whether you're paying tax every year or if you're paying tax at the end of your investment horizon. But what if you're a longer term investor in any higher tax bracket? So that's an analysis that we have done to see what happens if you choose to stay in a particular investment and you compound for a long period of time, whether that's 5 years, 10 years, or 15 years. And if you're, say, someone in your 30s or your 40s and you're looking at your retirement corpus, there's definitely going to be some portion of it that you can invest in debt. Given where we are in the market today, I think it makes sense to look at an allocation towards fixed income. I think Niranjan had highlighted what the opportunity actually was. Um, Also, we know that the RBI's target on inflation is going to be at 4%. That is, their medium-term achievement of inflation is at 4%. So we've taken a return assumption over a longer horizon at 6%, which is basically inflation plus 2, right? So what happens if you are at a 6% return and you can compound this money at 6% over a really long time? I think what you'll notice is your fixed deposit for the 39% tax bracket never actually crosses your inflation threshold. Whereas if you are compounding in a debt fund where you can defer your tax liability, then you begin crossing that threshold somewhere between 10 to 15 years, right? So making an allocation when you're in the higher tax bracket so that you at least have an inflation adjusted positive return is something that you need to consider today itself. It's not something that we should postpone because every year you lose in compounding, you're essentially going to lose some value there, as well as we don't know what the opportunities are going to look like from next year. We are at a higher interest rate scenario today. We see global growth decelerating. So can we take it for granted that next year interest rates will be higher? I don't think that's a given. So there's a need to act immediately in sort of securing your longer term investments. And there is definitely a need for superior fund selection if you're going to choose a route that allows you to defer taxes. So now when we talk about what these options are, because we're essentially looking at how to allocate towards retirement, I think there are a few things that can make retirement more efficient. So one of them is creating your do-it-yourself pension, right? A lot of retirees look at buying one particular product that will give them a payout for their entire years in retirement. But this comes with certain trade-offs in the sense that if you're going to buy an annuity or a pension plan, then you have to uh, pass over that investment to another company, and you may or may not get your capital back during your lifetime, which essentially doesn't make much sense, because as an investor you are always going to be better off if you have access to your capital, because you can decide what to do with it, you can take advantage of different opportunities. So making your own pension is completely possible with the power of mutual funds. I also think that this is the only product that allows you to compound and generate income at the same time. Because essentially you could follow a systematic withdrawal plan that would generate your income on a consistent basis. At the same time, you're compounding and allowing your investments to grow, and the tax that you pay is only on the capital gains for each unit that you redeem. It's not that even if you redeem only the profits, not every unit is going to be only profit, right? So this is, I think, the biggest sort of efficiency gain that you could get from mutual funds. So what about recurring deposits? Investors often ask us whether you should look at an SIP or whether you should look at an RD. And I think this is a big question that's going to come up now, given that the taxation is the same. So if you're doing a short-term RD or a short-term SIP, does it really make any difference? So I think firstly, your RD gives you a fixed return wherever you lock in. And today the rates for a recurring deposit are somewhere between 4.9 to 5.2%, right? Um, and of course, just like a fixed deposit, there are going to be penalties if you pre-close it, and you have a very defined investment term. Now, on the other hand, your SIP actually adapts to the market. So if you're moving into a higher a higher interest rate scenario, your mutual fund is going to reduce duration risk on that portfolio. If you're moving into a lower interest rate scenario, your mutual fund can adapt and increase duration. If credit becomes attractive, given the mandate, maybe there can be credit exposure. So this is more adaptive, and it allows you to capture whatever the prevailing trends are. Also, if we look at where our yields on debt funds today are, I think they're closer to 7 to 7.3%. You don't have an exit load, or you could choose schemes where there is no exit load. And of course, you have flexible investment terms. So if you decide after 12 months you want to stop your SIP, you can, but you cannot stop your RD, right? Uh, if you decide that after 24 months you still want to continue this, that's entirely your choice. So I think it puts a lot more power in the hands of the investor and the saver to decide what to do with their investments. It gives you the benefit of actually adapting to what is happening in the market. So an RD would work if you know that you have a hard deadline and you want an assured sort of return, and you're not willing to tolerate any variation in returns, because ultimately your SIP returns are going to be market linked. And of course, like the tax advantage is still there because you defer tax until you actually redeem your investments. Whereas in the RD, whatever interest you earn, you have to pay tax on that. So what is your framework for selecting mutual funds? I think there are five things that we would look at. So the first is to understand what is the fund strategy, right? Are you going to is this more of a tactical allocation where you're going to do it for a short time to capture a particular trend in the debt market? Or is this more of a long time buy and hold all weather kind of investment? If that's the kind of investment that you're making, then you need to be clear about the fund strategy. You need to have a good analysis of whether this suits you and suits the goal that you're going to stick in with. If it's tactical, also you need to see whether it's in line with the strategy that you want to play. Then you would need to look at the credit profile of the fund, understand not just the labels of AAA and so on, but to really see what is the quality of the holdings that are there within the fund. Then you would want to look at metrics like duration, um, to understand again how volatile this fund is going to be, whether you can stomach that kind of mark to market movement in the scheme. And of course, you would want to look at the exit load as well as the expense ratio, because these are two things that would help you decide your time frame as well as what your post expense return is going to be. Now let's talk about fitting bonds into your fixed income framework. I think here, essentially, because mutual funds have had like a particular shift in terms of taxation, and you want to stick, and it brings a sort of level playing field, right? So your FDs and your mutual funds are being taxed in similar ways. Your bonds and your FDs are being taxed in identical ways, right? So as your yields are higher on the bond side, you also have a variety of issuers. So if I was looking at a government security bond or a PSU bond, I'm getting somewhere between 7.3 to 7.5%, depending on the duration of the bond. Um, I'm also able to look beyond like government securities and PSUs. I can look at corporate bonds issued by different sort of companies, NBFCs, banks, and this gives me a larger variety to choose from. It allows me to take different levels of risk, um, and I also have an option to exit in the secondary market when I want to. Now, one important caveat to note is that the bond market is not that liquid. While you do have a secondary market, your exit conditions may not always be favorable. And it's better to look at this with a buy and hold sort of mindset. But you have so many choices in terms of aligning a bond with your investment horizon. If your investment horizon is 2 years, you can find a bond with a residual maturity of 2 years. If it's 10 years, then you can also find bonds in that range. So depending on where you want, you can always find a product that fits into your needs. You don't need to work around the limited available products. Whereas if you look at a bank FD, they all come at fixed tenors, right? It's 1 year, 2 year, 3 year, 5 year, and then you may have few other options in between, but pretty much this is what you get, and you have to align whatever you're doing within that framework. The second, since we were talking about exit, I think the capital gains taxation on bonds is slightly different. If it's an unlisted bond, it is 20% of gains. If it is a listed bond, it is 10% of gains. So again, capital gains are not something that we can take for granted. It depends on where you are in the interest rate cycle, what price you're able to sell the bond at, and whether you actually want to sell the bond or not, right? And we've already talked about your wider range of investment horizons. So there is a lot of positives in fixed deposits. So I think it's very appealing primarily because you get a guaranteed return, right? You know in advance how long you're investing, what you're getting back. It's very clear, it's easy to understand, it's straightforward, and it works in a lot of cases. But I think there is a gap that fixed deposits need to address, and that gap is actually filled by other products. So one thing is people take it for granted that everything is guaranteed, but there have been defaults on fixed deposits. We can talk about DHFL and we can talk about PMC Bank. Now, if you have a bank deposit that is guaranteed by the insurance deposit scheme, and that is up to 5 lakhs, right? So any deposit beyond that is not actually guaranteed. It's something that we take for granted because banks are systematically important, and it's very, very unlikely that in a regulatory environment, savers and depositors would not be compensated. But this is the fine print, right? And you've seen NBFCs deposit and cooperative banks like PMC default on their deposits in the past. Then you have penalties. So if you decide that you want to close your fixed deposit in advance, then you've got to either lose interest on what you've earned, or you pay some kind of penalty on the total interest that you've earned. And then, of course, the timelines are pre-decided by the banks or the issuing companies, and you don't get to choose what the right timeline is. And in terms of returns, what we're seeing and what we've consistently seen as a trend in the market over the last few years is that your bank deposit returns tend to be much lower than your market yields. So it makes sense to look for somebody who is looking at a more flexible product with different timelines or non-standard timelines with a slightly higher yield, and also not and variation in return. I think the gap can be filled with other products like mutual funds as well as bonds. So here are a few things that the industry just does not talk about, and they are great investments for conservative investors. So the first is your provident funds. This is across your employee provident fund, your voluntary provident fund, as well as your public provident fund. Now, your PPF is still tax free. There's no change to that. So you get a deduction up to 1.5 lakhs under ETC for an investment that you make. Whatever interest you earn is not taxable, and at the time of maturity, whatever you receive is also not taxable. So it's exempt, exempt, exempt. On the EPF as well as the BPF side, I think beyond a certain point, you will be liable to tax on the interest alone. But again, this is something that compounds for years together and goes towards your retirement corpus. So that is the way that we should be approaching other investment options like mutual funds, because you can allow things to compound for a period of 20 to 30 years and you get good results out of this exercise. The next thing is the NPS, or the National Pension Scheme. So again, here there is no, you do get a tax benefit on contributions under Section 80 CCD up to 50,000 rupees. The NPS basically allows you to invest in debt and equity at the same time. So if you're looking at a hybrid fund and you think that's a great option, I think NPS could definitely do better for you. And recent returns have been great as well. So if you look at the past performance of NPS funds, primarily because they're not disturbed, right? People aren't taking money, they're allowing it to compound for a long time. So your NPS is also a great product to invest in. And on your tier one account, I think there is a limit, a maximum limit that you can contribute. But on the tier two account, there are no such limits. And another good sort of change that came in this year's budget is that the senior citizen savings scheme, previously the limit was 15 lakhs and now it's increased to 30 lakhs. So, and at the same time, they've done away with your PMVVY, which was your Pradhan Mantri Vaya Vandana Yojana scheme. So here you get quarterly interest, and I think the rate has gone up to 8.2% yesterday. Uh, so these are three products that you could look at allocating. If you're younger and you don't have use for the senior citizen savings scheme, you might have a parent or a relative who could benefit from this. If you're older, this is something that you can definitely consider allocating to, because essentially it's a government savings scheme. There's no credit risk in it, and you're getting above 8% return, which is great at this point in the cycle. So I think we need to look at a mindset shift where we move from products to goals. So if we look at, say, what your goals are, right? So what is your return goal? Do you want reasonable certainty? Then you should be looking at a fixed deposit. If you want reasonable certainty, if you hold to maturity because you don't know what your principal amount is going to come back when you sell the bond, then I think bonds work. But if you're open to more market linked returns and you want to capture both the upside and maybe any potential downside as well, then a debt fund works, right? From a taxation angle, if you're comfortable paying tax every year and not allowing your investment to compound, then I think a fixed deposit works. And this is fine in the short run because you can't really see much of a difference in the compounding. But if you're going to look at a longer FD, or if you're the kind of person who renews your FDs every time they mature, then start looking at allocating towards debt funds. Um, Again, if you are looking at a trade, meaning if you enter into something like a bond where you're okay paying the tax on the interest every year, but you're also looking at a potential capital gain opportunity a few years down the line, then I think bonds would work really well. Again, when it comes to like your specific situation, right? What is your slab rate? If you're at a lower slab, there's not too much of a difference between a fixed deposit and a debt fund. But if you're in a higher slab, then definitely debt funds give you an advantage over deposits as well as bonds, right? And I think if your timelines are fixed, of course, you have to look at deposits or bonds where you know in advance when this is going to mature and what's going to come in hand. Whereas if you have more flexible timelines, then I think it makes sense to look at funds. And finally, to close off, I think we need to look at the silver lining in the finance bill. So there are, I think, five takeaways that we can look at. I think the first is bringing this uniform taxation or removing indexation benefit rather allows pure FD investors to stay within their comfort zone. So they don't need to look at mutual funds purely because of the tax benefit. They can look at mutual funds on merit, or they can stick to fixed deposits because it fits their bill, right? The second thing is that deferring tax, which is still allowed on the mutual fund space, really allows compounding to do its magic over a period of time. So we saw that chart where, your if you're in the 39% bracket, then somewhere in the 15, in year 10 to 15 is when you breach inflation and you make inflation adjusted positive returns. If you're in lower tax brackets, you reach the target much sooner. And uh, I think the next advantage is that this allows you to do tactical allocations to debt themes, right? So if I'm looking to play a duration theme or if I'm looking to play a credit theme, I no longer have to wait for 3 years. Previously, the intention was always that, okay, I would do this and then I'll wait until it's long term and then I'll get out. Now, because you don't have this weight of long term hanging over your head, you can do it and get out when the time is right. You don't have to wait for a tax benefit to show up. And it allows us to make more informed and practical decisions. I think the next thing is we should always trust industries to be innovative when it comes to financial products. We will see newer products that may cater to different needs, things that we've not seen because of certain disadvantages. Uh, we might see new products in the balanced hybrid space. That seems like an obvious sort of choice for the industry to branch into. Uh, but we need to be careful about what is hot money, whether the portfolios are well managed, what kind of strategy they're following before you sort of jump into anything. Uh, I think the key lesson from the finance bill is that, stop thinking about tax so much, think about what's right for you, right? And as long as you're following that process in product selection and making your investment decisions, I think it's going to work out really well in terms of wealth creation. And of course, it forces us to think long term, right? Like now I'm thinking about allocations that would stay in those particular funds for as long as the investor wants. So whether that's 3 years, whether that's 5 years, whether that's 10 years, or even longer, so that essentially you're allowing your compounding to work, you're allowing yourself to take fewer decisions and be more comfortable and choose better products that you can live with for a long, long time. And I think with that, we can open for questions. Thank you everyone for being here today. You can type in your questions in the chat box. We'll be happy to take them. What if the debt fund model is applied to equity funds also, if the government wants to do this in the future? I think that's something that the government would have to answer.
Yeah, I mean, that's certainly see inevitability of taxes from where we see it as a house. I mean, it's inevitable. Well, we might see tax rationalization, but it's a call that government has to take. But to be fair, I think the debt fund taxation, see, people who are invested into debt not for the sake of being invested into the asset class. I mean, see, debt as an asset class is something that we always advocate from our advisory practice and our financial planning practice. We tell clients to hold debt as an asset class because there is as part of essential asset allocation that should be there. So more people, unfortunately, from where we saw it, took it the other way around. They said they took it for tax purposes. So at that point where we are seeing, I think it's going to be an interesting space. Amrita, you have something to say?
No, I think from a tax perspective, we can't really predict what the government does, right? I think this year has taught us that because the MLD arbitrage has been open for a really long time, and you've had many products in the industry, including AIF, sort of use that space. I think the way we need to approach it is while there's a tax benefit, or if you see some advantage, like take advantage of it. What we have now is on the debt fund spaces that you could defer your tax liability, right? As long as I stay invested, I'm not paying tax. Only when I take out gains, am I paying tax? Now that based on that today, if you're looking at taxation, um, then I think you should make your allocation today. You never know what's going to come tomorrow, right? They could reverse this, they could change equity taxation, they may bring FDs and debt funds in line in the same kind of taxation. Any number of things are possible. And none of us would actually know about what the government is deliberating. Because so if we think about how this announcement also came in the budget, they announced about market linked debentures and the tax benefit being reversed there, and the amendment came in last Friday. So investors have literally, that was passed in Parliament last Friday. So we were talking about it on Thursday. Friday, the bill gets passed in Parliament, and investors have had 1 week to allocate into fixed income to continue to receive their indexation benefit. So similarly, if we look at long-term capital gains being reintroduced to equity, that also happened in a budget event. You had a couple of months to sort of plan your portfolios. So we need to be adaptive instead of trying to predict what the government will do, how they will do it, or being fearful of making decisions because of some tax rule change. If there is merit, today you are getting a high quality government security investment at 7%, right? For 3 years or 4 years. Now, I think that's a great return if I'm making that no risk, no problems. That's a good return in debt because your long-term inflation is going to be 4%. So maybe this year will be bad, but in a few years you'll settle down into that target, right? And then if I'm making a 6 or 7% return, I'm getting a good spread over, I'm getting a positive real return. That's good enough. I think that's the framework in which we need to operate.
Just also to add to what Samyukta was saying today, you must understand that today in India, after a very, very long time, we are moving towards a positive interest rate cycle. So where the net interest is basically your current India repo rate minus inflation should be greater than zero. So in that kind of scenario, I think you should be looking at it from the merit of the product there. Yes, sir.
Yeah, I'll just take the second question, which is how about NPS as an alternative of debt for retirement? Yeah, this is a great product. Like, do some research on it, talk to your financial planner, talk to your investment advisor, see what is a suitable allocation in your case. Because essentially, there are different categories of funds that you can choose in the NPS. So you can choose to auto rebalance. So based on your age, your debt and equity exposure will get adjusted, or you can choose your own fund. And I think within the NPS scheme, you can switch from one fund to another. There's not really like much of a tax liability in that case. Um, and this is a great product. So definitely explore it. It's something worth looking at. Not many people are going to be talking about it primarily because, again, I think there's always incentive to push certain things, right? There's not too much incentive from many like industry representatives to actually look at NPS. All right. The next question. Uh, sorry. Sir, did you want to say something?
Nothing. No, please take it.
Okay. So the next question, is this a good time to invest in long dated papers or mutual funds with the hope to exit in a couple of years once interest rate reduces? So I think if we look at the yield curve today, it's pretty flat, right? So my 3-year paper is at 7.3 to 7.4. My 5-year paper is at the same range. My 10-year paper is also at the same range. So in this case, if you do take duration risk, right? Like if you look at, say, buying the 10-year, you need to be conscious of the fact that two things could happen. One is today the 10-year may be fairly priced and your 5-year and your 3-year may reduce, which means you won't get much of a duration movement, meaning a mark to market gain in buying a 10-year paper. The second thing that could happen is that the entire medium to long term may not be fairly priced at all, right? In which case, if you take a 10-year paper, you could have some mark to market wallet loss over the next couple of years while that happens. And you will essentially be at a higher yield. So in that case, if you are careful with your portfolio construction, meaning you think today it's an attractive yield, and if that happens, you know how you're going to respond to that situation, then probably through the course of a rate cycle, you might be able to make a good return on that. Alternatively, if you just look at this as not a trade and you say that 7.4% I'm getting for a period of 10 years, I'm comfortable with that return, then you hold to maturity, you don't have any problem, right? So, knowing that this could play out in multiple ways and in ways that we may not anticipate also. So, I think the strategy then would be incremental, right? Today, I know what's happening. I have little bit of visibility. I act on today's knowledge. Then tomorrow, if the market changes, then I need to respond to that situation and adjust my strategy accordingly.
But also to add to what Samyukta was saying is that one thing we have to understand, see, the past where there was a trade available on all these longer term papers that you could walk out, where you could do a flip, you could do a trade. Given the fact that I think even rate cuts might not be large, the last time things like this happened was one in 2008, and the other time was in 2019. So these are the only two times where you had this kind of an arbitrage where there was a drastic rate cut, and then you had a large MTM that came through. But from what we think and what we see is that might not be the case. Yes, I mean,
Okay. So how to go about international funds and gold savings? So I think in this case, you really need to again look at it from a point of merit, right? If it makes sense to do a global investment, then you would buy the fund. Of course, the tax liability would affect your post-tax return. So you need to calculate whether it's that attractive for you to make that investment or not. And in terms of gold, also you need to look at it. So if you see, we have a multi-asset product called Sphere, and there we were early on gold. Um, so you need to buy it at the right point in the market cycle for you to actually make a good post-tax return on the product as well. So always look at things from a merit perspective, right? Ignore the tax angle first. See whether it makes sense to do the investment or not. If it doesn't make sense to do the investment, don't do it. If it makes sense to do it, then think about the tax liability. Okay. The next question is for NRIs, how the taxation impacted considering indexation was not available anyways. I think if you did not have indexation before, then it's the same thing. So it will be taxed at whatever your total India income slab rate is. So if you have properties that you've let out and you're earning rent, or if you have other sources of income in India, then you will compute your tax slab and that's how you would be taxed. Okay. All right. So this is with respect to NPS. Minimum 40% goes for the annuity and NPS, whether it is repayable at any point of time. Um, so I think with NPS, yeah, you will have to commute a certain portion and you will have to convert something into an annuity, and that is 40%, I think. And 60% you can take out. So you're not forced to convert the whole thing. If you want to convert it into a pension, you can. If you want to do more, also you can do that. Uh, but it makes sense to have some amount of fixed, right? Anyhow, even if you're working in and you have your EPF, even that some portion you can convert into a pension scheme. The idea is not to have your entire money locked up. Um, Whether any steps will be taken by AMC to hold their customers. I'm not sure what you're asking in this question. So maybe if you can let us know what it is that you want from the AMC's perspective, uh, maybe we'll be able to shed some more light on that. All right. So question from Mr. Sitaraman Bhaskar. Uh, Thank you, sir, for the compliment. Do you provide advice to invest on mutual funds based on our goals and risks? How do we approach? Yes, we do. So there is a separate company that does mutual fund distribution, and they can help you do goal mapped investments. We can put you in touch with one of our representatives. So essentially, they will try to assess your risk profile, based on which you'll have a framework of funds which might be suitable. And they'll also help you goal map your mutual fund investments, including your SIPs as well as whatever existing holdings you have into specific goals. Okay. Okay, so The next question is 65% equity, 35% debt will be a good choice for dividend or growth in mutual funds. So I think if you're going to go with a product that's 65% equity, that's predominantly an equity product, you might as well look at just equity investing, right? Why do you want to dilute that with debt? The second thing is if you're worried about volatility and you feel that a hybrid fund is the best choice, then be conscious of the underlying fund strategy, look at the expense, see whether that actually suits your goal or not. Ideally, the better way to manage this would be to keep your debt and equity separate so that you can manage the tactical call of when to exit and when to scale up. So this year, for instance, if you feel is going to be a very volatile year for equity markets and you don't want to make a negative return or you're worried of a negative return, then allocate to fixed income. You'll definitely make a positive return this year, right? We are at a fairly high interest rate, at a high point in the interest rate cycle, and you're also getting good yields without taking any risk. So do that. Like, it's up to you. You can manage your movement, or you can work with an advisor who can manage that movement more smoothly for you. Do we have any more questions?
Yes, I think you can. I mean, it depends. One, I think where you are today. So I shall take this question, Samyukta.
Sure, please.
Sure. So, okay, can we continue? Can you continue with our existing target maturity funds? I think, yeah, you don't have. I mean, you can edit one. There's no harm in it. And just wait for maturity because whatever you put until the 31st of March, you're eligible for indexation on that. So just run it. And secondly, I think if you're locked in and if you're locked in with the right yields, I think it makes a lot of sense to just hold. Because as it gets closer to maturity, the volatility of the space also will go.
Right, we'll wait for a couple of more minutes in case we have any more questions from anybody. Your opinion on rates and index.
See, InvITs offer cash flow. So, but yet, see, now today, what's happened on all these on a rate or an InvIT is that the government has made all these instruments as a level playing field for you. So you have to be just to make it clear on rates. You're being very careful as to what rates you're putting money into because all rates are not equal. And on InvITs, please see the devil is in the detail. Simply because a lot of people think the price at which you're getting InvIT also has a component where your principal is returned. So a lot of people think that they're getting only the interest. So they don't seem to understand that you also get your principal back. So you have to take that also into account.
Yeah, also like within the real rates, I think you have um, there have been some shifts in the market itself, right? In terms of post-COVID, you're seeing more companies being able to operate in a hybrid model rather than everyone working from a particular office space. So that is a risk that you'll need to see how that plays out, like in the long term, whether this trend of like working from home or hybrid work continues or not. What is your view on international funds?
See, it has to be on a completely case-to-case basis. So, I mean, you cannot paint everything in the same brush because it has to be very specific on what part of which international fund you're picking, what you're picking, and see if that geography has the ability to do well. So there are a lot of things. So, for example, I've seen there was one fund from South America that was being touted as the best fund. Unfortunately, that fund over the last I think it's been quite a while. It's been last 10, 12, 10 years has underperformed. So, but then there are other international funds that done exceedingly well. But that being said, all this is completely on a case to case basis.
I think from also on the international fund space, like we are in an era of low global growth, right? That was one of the uh, points that we talked about very early in the presentation. And so you need to be careful. Where are you allocating money? What are the risks that are there in the economy? Which sectors are you looking at? Are they actually going to like grow in this space? Or how are you going to plan your investments? Can NRIs invest in SGB? I'm not sure about the answer to this question. I actually think that they cannot, but we can check and get back to you.
And also to add to what Samrit was saying on the era of international investing, you have to take into cognizance the fact that we've had ultra low interest rates since 2010, 29, 20, 2009 globally. So which basically all this growth that you had came, let's say, at 0.5% or 1% cost of borrowing. So which means that the entire delta that came for all these companies that did really well over the last 10 years or 11 years came from this. So now that that space has shrunk, so which means you have to say how they're going to be able to generate delta.
All right. So I think if those are the last questions, then we can wrap up. Thank you everyone for joining us today. Um, Please do, if you have further questions, you can always reach out to us. Our coordinates are on the slide. So you can get in touch. We'll be happy to answer your questions. If you like to discuss anything else, our team is also here. So please feel free to get in touch. Like your details are with us. We'll be happy to talk to you. Is there one last question?
I think there was one last question. One moment.
Thank you, sir. We're very glad that we
Thank you so
were
much.
able to help you
We're glad
today.
you were able to make it.
All right, I think there are no more questions. We'll close for the day. Please do reach out to us personally. We'll be happy to take the conversation forward and see you next time.
Thank you so much. It's a pleasure having you here. Thank you so much. Good day to you.